Good morning, everybody. How are you guys doing? Happy St. Patrick's Day. May your parents be forever green. Yes, exactly. No snakes. Good morning. What's up? Doing great. Ran the Shamrock 5K. I don't know what that means, but good for, that sounds healthy. Weekend was okay. It was I spent like 20 hours trying to learn to use Illustrator. Which makes me hate Adobe even more. Bruh, I know. That's way below your hourly rate. Maybe. I use Corel. It's disgusting. Does that still exist? I haven't heard of someone using Corel since I had a compact laptop. Flashbacks to Word Perfect. Didn't you have interns slash simps for the work? Yeah. It's pricey as fuck, but I'm not renewing my old version until I have to. Huh. You can't trade stocks on that. I know. Designing a logo? I don't know what you're talking about. Happy Drunkard's Day to you too, JC. All right, well, I guess we should dive right into it because we're probably gonna have a lot to cover. This week should be exciting, to say the least. Um, we've got the BOJ decision tomorrow. We've got FOMC on Tuesday. I think after that it kind of calms down, but those both or no, I'm sorry. FOMC on Wednesday. What did we have Tuesday? There was something. Building permits, some shit like that. I think we have like housing stuff this week. And I think we start getting PMIs into the back half of the week, like S&P, maybe manufacturing. I've worked with Illustrator for 4 years, and I still just know just 30% of all the functions. Excellent. Ham flour made me salmon toast. That's nice. I find Fiverr easier than Illustrator. That's probably not wrong. USD is going to be a roller coaster of yuan and yen battling each other tonight. Yeah. Um, well, tonight into tomorrow, right? I think tonight we have machinery orders from Japan, and then huge data sets out of China, like industrial production, retail sales, unemployment, all on the back of them not moving up their midterm lending or moving down their midterm lending facility rate, which no one's happy about. So HSI's just been tanking into the back half of the week, and frankly, if any of those are down, like industrial production or retail sales, or and they're expected to fall a bit, but if they fall below like the expected levels, it's probably not going to be a good look. I think fixed income as investment is expected to rise, which it probably will because they've been buying a lot of U.S. Treasuries in order to stabilize the yuan. But yeah, we could get some bigger moves in like Dixie tonight. Can you talk about Diet 103 and its correlation between Beyond and his backed up plumbing? Maybe suggestions on how to get things moving to get him to kick off the run. Well, we'll go into Beyond here in a minute. I'm probably gonna cover GME first. It's got earnings coming up the week after this on Tuesday. Reg Show is, or XRT is still not on Reg Show. I think Kapow has been charting his progress. I don't know what the hell you guys are doing in there. Every time I look, it looks like you're just trying to like scalp 30-cent runs on Beyond. Which, I mean, I guess is fine, but it seems like a very unprofitable endeavor. Lots of, the usual poor shit, like buying weeklies, sitting on weeklies, at the end of the week being like, thank God my weekly's printed. You're all guilty of it. I keep my eyes open. People buying shares of Beyond might be the most disgusting thing I've ever seen. No, you. All right. Don't kink shame. I mean, I'm not trying to kink shame anybody, but it's a pretty garbage company. If the market like crashed tomorrow, or started to crash tomorrow for some reason, um everybody who's ever owned Beyond and still owns it will sell every share they have. So AMP and Tradeovate are pretty good. I don't like Tradeovate that much. But they're cheap. They have good commissions. It depends. It depends on how you trade. IBKR is a little bit more on the commission side, but not much. I personally like AMP, and like Sierra Chart. Although that can be kind of hard to use if you haven't been doing this forever. So maybe like Quant Tower or something like that would be a little bit better. 1 second. All right. Kirk, you're on the big screen. My wife is here. What's up, Carl's wife? IBKR wants the full initial margin. They don't have day margin for retail like AMP does. So trade one ES, you need to have about $15,000 initial margin. I think that's just because you're European. Although I have a bunch of money in my IBKR account, so I might be wrong, but I've never had that issue. All right, so what do you think? We'll go over the memes, try to get through some of the Mag 7. Same requirement for USA. Yeah. But it's IBKR. You get it all in one place. $15,000's not that bad. Listen, if you don't have $15,000, should you really be trading futures? You just have portfolio margin. Yeah. All right. Let's get started. Because we're gonna have I think Dork and J Fresh popping on later. Um, so GME getting pretty illiquid, especially since earnings were announced. I think it was like earlier this week. Hold on one second. I gotta close all this shit. So, seeing pretty steady shorting ever since earnings were announced. This is true on XRT as well. Part of that's, the market coming down, mid caps kind of faltering a little bit alongside IWM starting to fall towards the bottom of its support level around like 200. Um, if there is any kind of continued correction this week that extends out past Opex, we're probably going to see continued shorting here. There's still a decent amount of liquidity for them to short. Just on GME itself, I don't think there's any significant spike in borrow fees or anything like that. XRT is also pretty liquid still. There's been a lot of covering on it over the last month and a half. Um, so I don't think they have any problem shorting. And this is kind of the problem as we approach earnings is with XRT still off reg show. Even if earnings are positive in some way, they're going to have a lot of liquidity to bring to bear. So we might get shorted into earnings and then a spike on earnings, right? But that might get shorted down very, very quickly because, frankly, they have no lack of shares to short right now. So I'd be really cautious of that. I'm probably not gonna play it. Um, just the idea of just buying calls and hoping it prints is pretty lame at this point. If XRT somehow ends up on reg show before earnings, maybe I'll change my plan. But right now, I'm not a big fan. Curious about Planet Fitness. I think if story gets picked up by politicians on top of bad earnings, it will tank. What story? Is there more to that? Transgender woman in the women's bathroom. And they canceled the membership of the woman who complained, ripe for political payback. I could get spun up in the news cycle during an election year. Maybe. I don't know how much it'll affect their stock, but yeah, I guess it's possible that it has some negative effect. It might not, right? But one side, I can see one side of the political spectrum being very pissed about it, and the other side being very happy about it. Generally, when you have things that are kind of like Budweiser, remember that whole thing? It generally doesn't have an immediate effect. Calls for boycotts are not great for retail. Yeah, but it's like impossible to cancel a gym membership. So I don't think it's gonna. I mean, it's probably not gonna affect their earnings, right? I think they've been doing pretty well lately too. Uh, Actually, not that great since their last earnings. We're down about $6. All right. Yeah, maybe worthwhile. There's a technical short there too, so that's not too bad. Upstart. This one's actually more impacted by the news this week. If the FOMC meeting leads to fewer cuts into the end of 24, um, this is probably going to take a hit. It just fell back under the 25 level and kind of held there over the end of the week. There's still pretty decent liquidity on it, although it's starting to dry up. And still, very exposed to runs on bots due to Nvidia. So this one could I guess this one could kind of go either way. I know Nvidia has like a big keynote event this week on AI. Um, and if something that comes out of that event causes Nvidia or other AI stocks to run, we'll probably see a lot of positive pressure on bots, and we can see Upstart bounce back up to the 25 level briefly. But I think in the long run, if we're looking at another 6 to 9 months of tighter credit conditions, Upstart's probably going to pay the price for that again. It doesn't like tighter credit condition cycles, and there's not a ton of shorts on it right now. So there's still plenty of room for them to push to the downside, with maybe some volatility in the short term. I'm still short it until I think April Opex. I've been short for a couple months now. Um, it's been fine. I probably wouldn't enter short positions on it this week, but if the FOMC dot plot isn't really favorable to them, or we see two rate cuts or one rate cut into the end of the year, um, I would expect them to get shorted back towards the $20 level, maybe lower, over the next couple of months. And that might blow off some point in the middle of summer. Do you see Upstart falling below 18? Are you still thinking that's around the floor with the current macro? It could. But we would need to see shorts piling into it like we haven't since like early 2023, right? Like back here. I still think we're pretty far from that. I mean, if we look at short behavior now versus back then, it's very different, right? We don't see shorts piling in nearly as hard. Um, we really don't see it the other way either, right? So yes, we could, but I think the bear case would need to be a bit stronger. Something that's really important for Upstart, particularly in defining the levels it trades at, is the SLOS report. And I think we're still a few weeks out from the next one. If intrabank credit conditions are still getting worse, which the last one was like back here. Um, if interbank credit conditions are still getting worse, then that's going to reinforce the bear case for Upstart. So that's going to mean 6 to 9 more months of taking those loans onto their own balance sheet with no one to really pass them off to. And that's when things start to get really bearish, and we can see that like sub 20, sub 18 price levels. I'm not sure that the FOMC report alone will be enough for that. But also remember, any serious correction in R2K can proffer up some liquidity to get this pushed down even more. And losing the 25 level is a pretty big deal. Most of the support that came in last year was built at that 25 level, right? And so, if we're losing it now, we may be headed for like another period of reduced prices and like accumulation. I know they haven't advanced their share buybacks significantly. Maybe they're waiting for this opportunity to do that. But I think Upstart's still so illiquid that we're gonna see it start shuffling on and off of reg show if shorts get really serious about it again. All right, Fubo. So Fubo's getting shorted. It's been getting shorted ever since earnings. It's been pretty relentless, but we've managed to hold the 150 level. Um, yeah, I mentioned last week that we were likely to continue holding this level. It seems good. I think Upstart or Fubo has done a good enough job making their stocks so liquid. Um, that it's really not very attractive for short vol. And so, ever since I think ever since like uh, their third positive earnings back here in November, we haven't really seen short vol piling in, right? Like, for most of this period, we didn't really see any shorting at all approaching earnings. It wasn't until the lawsuit was announced that we actually saw some like bigger short positions being taken. And now post earnings with slightly reduced guidance, we are seeing a bit more shorts pile in, but they're still, I would say, not very aggressive. The range down to $1 is still open, but there seem to be plenty of buyers here at 150. So I would expect that to hold as long as there's no, major index correction or anything like that. Tupperware is this one's kind of interesting. So they got about 2 weeks left. to file their report for their turnaround plan and their financial statements. We've been seeing moderate covering over the last like 4 trading sessions. Price has slowly been moving up. They're netting off a decent amount of that volume around the 150 level, and still, trying to close each day below the 150 strike. So far, that's been pretty successful. They've opened up a little bit of liquidity, um, but it's still extremely short. I mean, if you look at periods where the stock is actually quite liquid versus now, you can see that the short position is very, very entrenched. Um, Obviously, whatever Tupperware announces will determine whether or not this runs, but um, the board the board has been pretty clear that they want to get the financials out there before the NYSE delists them. Um, and supposedly they have some kind of turnaround plan. They had some issues with accounting that delayed the release of the report that was supposed to come out in February. We're now moving into the back half of March, and we still have no financial report. I'm not even sure if the audit is completed. They haven't announced anything. But in the event that it is positive, or they're not immediately going out of business, there's a substantial short position that is still underwater. Um, and that could very easily be squeezed out. And yet they're worth more than BNED. Yeah, that's true. They have like double the revenues of BNED, which is probably part of that. They're also a pretty mature company, right? You don't know that? Okay, that's actually true. You're not wrong. Historically, though, people eat more than they read. Fair. Do you think Upstart will have another crazy run in the next year, or is the main vol short play over now? No, I mean, I think there's still shorting going on Upstart. And we're getting into a period where it's starting to become kind of illiquid. We're just not getting shorting like we've seen in the past. So I mean, short positions definitely aren't as entrenched as they were back here in like early 2023. And they haven't shorted as hard as they did back here at the end of 2023. But like as far as financial conditions go, we're in a very similar place to where we were in like September, October of 2023, which means that we are seeing short positions accumulate. They just haven't accumulated a lot yet. So I think Upstart is very sensitive to big runs if any of those conditions change in any meaningful way. So as long as credit conditions are tightening, especially interbank credit conditions, you can pretty much assume that shorts are going to kind of accumulate over time. Um, but if that changes, then Upstart will probably run, and it'll probably run really hard. It's very illiquid. And even just from the sense of like bid ask spread, and price realization, Upstart has a huge advantage on that, right? And in a very similar way to GME, how when GME is seeing covering, its price goes up very rapidly due to DRS. Upstart's similarly illiquid, and actually more so. And there's still way less available ETF liquidity compared to a lot of the other like kind of illiquid meme stocks we watch. Beyond, this is kind of the last one. Still on reg show, as of Friday, as far as I know. Um, we've been seeing most of the covering that occur below the trend. That's been benefited over the last couple of days by drops in indices, which offer up some liquidity, but we are starting to push up more consistently into that 850 level. We tested 9 in the earlier part of the week. If you look here, you can kind of see the point in time at which shorts accumulated, right? If we go back right here, right, you see the short accumulation, and then we see the short covering, right? And this is pretty much um, what's going on is level by level. They're covering those underwater shorts. So over time, like I've said a bunch of times now, over time we're getting continuous price improvement, right? So if we look over the entire period from its most recent low, net, it's up about 9%, right? And we've gone as high as like 16% up, and obviously we've had some intraday drawdowns, but you know as time progresses, the price of the underlying is continuing to go up, right? Which is kind of how this gets played. And then eventually we'll run into a pocket of ETF FTDs or something like that that require even more covering on the underlying than simply netting off reg show requirements. And this is really similar to back here where it was on reg show most of this entire period, right? And then as ETF FTDs started to come in, and we start to get covering outside of the underlying, right? Price starts to improve much more rapidly, and then it comes off reg show over here. This has been pretty consistent over time, and with all the shorts created up here post earnings, I don't think there's any concern that there's going to be a large amount of fails in the ETFs. Speaking of FTDs, I think I got your DM, but I've got to check the counts. When I looked, it seemed wrong. I think you're adding like T35 to reg show FTDs, but I'll double check it. You seem wrong. Do you have any idea what ETFs were used to short this a few years ago? Oh, Avis? No, but yeah, it's been I think the glory days of its insane runs are mostly over. But I could tell you, yeah, I think it used to be in small caps, like going into 2021. Like when it first started running really, really hard back here in 2021. I think it was still in the small cap indices. So like IWM and shit. And then I think it moved into the mid caps where like GME is. So IJR, IJH. Is FUBO 150 level good for CSPs? It's okay. I mean, I short strangled it last week, like a covered short strangle. The yield was all right. I think it was like 7% or something like that. I mean, you could always sell like 150 CSPs and then like commit to buying an equivalent number of shares should it fall to $1, right? And then you'll end up with like, like a 125 cost basis, which is not bad. Is Berk B going to continue its upward trajectory? Maybe for the time being. I mean, it's largely tied to like index performance, right? Maybe slightly more defensive. Not bad. In the event of a like any kind of large market sell-off, though, it'll probably go down pretty hard. Or if Buffett dies. If Buffett dies, I would expect it to sell off very, very hard. But I mean, if we like pop the SPX on top of this, right? It's not gonna be that different. Maybe slightly overperforming. I think SPX went down what 15% and from like August to October. Burke went down about 11. So it tends to do a little bit better on the downside, just because Buffett generally has more defensive holdings. I think that's about it for the memes. Do I want to talk about BTU? BTU is approaching the bottom of its trend again. Um, I would be a little cautious given the uncertainty of what's going on in the Chinese economy right now. Coal prices have not enjoyed the last couple of weeks of Chinese economic data, um, and it's getting pretty close to failing its trend on a larger spike in volume, which isn't completely unusual, but it's a little rare. Um, I would be careful selling the 2350 CSP as an income strat. I think the chances of getting assigned right now are pretty high, especially if tonight's economic data continues to be bad. So I know a bunch of you are in BTU and you really love selling CSPs on this trend. Just know that if you do, there's a good chance that you could get assigned. Yeah, I still love T. That's been awesome. I'm not finding many people around liking T or VZ. I guess for their debt. I mean, their utilities. They're always going to carry a ton of debt, but they have massive, huge cash flows. So it doesn't really matter. I think utilities in general have just wildly underperformed the S&P, right? Like if we look at utilities compared to SPX performance, it's been shit, right? However, if rates do come down, and this is also kind of a hedge against like a credit event or something like that, where the federal funds rate could drop substantially very quickly. Um, a lot of those companies are going to be able to refinance all that massive debt at cheaper levels, right? Um, Not to mention, currently, I don't think Verizon nor AT&T have any issues paying off their debt. Um, they have, several billion a quarter in cash flows. They're very stable companies. They're not going anywhere, regardless of the lawsuits and all the other bullshit. And they've performed moderately well recently. They've started to kind of dig themselves out. Not to mention huge dividends that likely aren't going anywhere anytime soon. And I think they both pay around like 7%. So if it's something that for me that I'm holding and allowing to just compound on drip, um, and just kind of waiting out a more negative, economic cycle where defensives are more sought after. Is UGI also China dependent? Not particularly. Nat gas, which sure, yeah, it's kind of a tertiary effect. But I mean, yeah, UGI is gonna. It's also a utility, right? So it's not gonna perform that well, but it will perform more in line with nat gas prices, since they're a large seller of natural gas um, through their nat gas. Well, they're still rolling out those programs, but they're working on becoming a larger distributor of natural gas through like the Northeast corridor. I think they've performed pretty well since I bought in. I haven't had any issues with them. And the dividend there is pretty nice too, but not so affected by China. Energy, energy, and then like some commodities are more affected by like iron ore, um, coal, iron ore and coal very specifically are very affected by the Chinese like state of the Chinese economy. I don't think nat gas so much. Nat gas is more worried about extended winters, power production, um, and shipping. Right, a lot of the nat gas pipeline that we have right now was developed after the Russia-Ukraine war, and it's kind of a new supply chain, and but it has felt some of the effects of the conflict in the Red Sea, right? You have a lot of nat gas, especially coming off of the like east coast of Africa into Europe, and the direct shipping line for that is the Suez Canal. With the Suez Canal blocked, it's taking a lot longer to get that nat gas to market. I mean, you're not going to fly a nat gas, like a multi-billion-dollar nat gas storage ship, like through missile fire, right? So they have to go the long way around, which is slowly increasing nat gas prices because supplies are getting a little lower in Europe, kind of incrementally, month over month. But I mean, as far as UGI goes, if you look historically, um, all the way into the COVID crash, it massively outperformed the S&P, right? I think their average, like through this whole period, they had like 12 to 13% annualized growth versus the S&P. So they did really really well. And they've started to catch back up post COVID. But then we ran into the Russia Ukraine conflict and the massive oversupply of natural gas, and that dropped their price really really hard. As far as the company goes, though, I think they're still really well run. I think they have more than enough money to continue to pay out their dividends, and they're working on picking up more, well, more acquisitions, and they're growing their nat gas pipelines and nat gas creation. So I think they're pretty good. I mean, obviously do your own research, but I own a bit of it. Yeah, no problem talking, man. All right. I don't know how many of the Mag 7 I'm gonna get through, but we'll start with Apple. So we kind of expected Apple to find a little support and bounce back. It did. over the last week. Definitely helped buoy index prices a lot, especially with Nvidia's failure. Let me take a look at the options chain on it now. I still think it's mostly neutral. I know a lot of you have been selling credit spreads on it, and that's been really good lately. Simply because the fact that the price isn't really doing a lot. But let's see here. So it looks like Friday it bounced pretty directly off of Delta neutral. Dealer Delta is still negative, and a fairly significant chunk of Delta fell off, about 3 billion, with the monthly expiry on Friday. Um, Gamma is still positive, but just barely. Um, Charm's pretty flat, and bot calls appear to be falling off. We're also seeing a reduction over the last more than a week. I guess it's about 6 days in short puts. So this brief bullish sentiment that we saw picking up alongside CSPs being sold, kind of in the like 68 through 65 range. We got a big accumulation of short puts here. Those seem to be closing off at the end of this week. We're starting to see more calls open up here. Probably going to see this start to trend down again, flat to down. Right. This is all of this is going to be very, very slow over time unless indexes sell off substantially in some way. So yeah, I would say that we're kind of entering another down cycle on this. This might be a good opportunity to um, maybe sell more like bear credit spreads above that like 75 mark. You want a little bit of range because you want to be able to get out in case there's some kind of unexpected news or something like that. But it doesn't look like there's very much like call side accumulation above 75. So yeah, kind of slow down or flat, not very interesting. AMD's been going kind of wild lately, so we'll take a look at that. Um, had a big bounce Friday alongside Nvidia, and I expect this coming week it'll pick up some tailwinds from Nvidia's event. And now I know this isn't part of the Mag 7, but let's see. So Friday's bounce right off of gamma neutral. Um, Tested a high around 193 and then kind of pulled back a bit down to 187 into close. Also fell alongside Nvidia into close where we saw the pump fail. I would say that call interest on this has fallen off substantially, but there's some risk. There's some risk from the Nvidia event this week. So there's an opportunity to short this, and if it slips gamma neutral, which is kind of right where it is, that this support here is basically, I mean, GN's like right here, just above it. Um, so I would say that if it slips that, there's a chance that it pulls down. Oh, let's see, maybe around the 166 range to the downside. Um, if it finds support then there again, though, it could bounce. So maybe just look or set an alert for that price level, right around 184.24, and if it breaks to the downside of that, it might be worth considering like a short dated put on. Amazon. All right, let's see. Amazon still just looks pretty stable. It dropped a lot of delta with Friday's expiration, about 8 billion. Gamma dropped by about 500 million, but it's still positive. Charm was a little positive at the end of the night last week. So like tomorrow, Amazon might see a little bit of downside, maybe like the 172 to 171 level. And then I would wait and see if calls reaccumulate on it. Not very exciting there, unfortunately. And it's in a range that's very stable. It's really high above Gamma Max and Neutral. Those are both down around the 140 mark. I wouldn't say it looks like Amazon's breaking down anytime soon without indexes moving first. Google made most of the recovery that we talked about. I kind of wanted to go long on this a couple weeks ago, but I missed my entry. I know a couple of you did follow through on that, and congratulations. It did bounce back pretty well. This was, I mean, simply it was just a little bit oversold. I think the recovery was kind of necessary. And now it's a little bit more in line with the rest of the Mag 7. However, that's the wrong stock. If it falls back under the 139.76 level, it's probably going to start to fail. So I would keep an eye on that, especially after the rejection Friday and the large drop. There is some supportive call positioning coming in at like the end of the day there, but it's not very much. And so if it continues to fail, I would look to the 139.75 and the what is that, 137 levels to confirm that failure. And if it does, you know, obviously that downside that it just broke back up through could it could kind of revert back through that, and you know, potentially a low around like 132-ish. So about $10 range, should it fail. To the upside, it doesn't look very good. Not a lot of call side accumulation or anything. How often do large cap stocks bounce off GM like that? It's not usually a support, right? Indicates participants don't want them going down and forcefully pump them up. So GN can be a really strong support if there's a large concentration of options interest at that strike, right? It's kind of a dead zone for hedging, right? Like as you approach it, market maker hedging reduces, and so very frequently, you know, you'll kind of end up seeing a bounce or a rejection on gamma neutral. But it's not always like the largest interest strike, right? And there's times when there's not a lot of positioning at gamma neutral, like, or weaker positioning, right? And then you'll end up kind of passing through it more easily. So I mean I think you're seeing the bounces here largely because positioning is just very large at that strike. But also, yeah, I mean, they don't want them to go down. They don't want the market maker hedge to flip to, you know, net negative gamma. Especially if they've been selling large numbers of CSPs in below that range, which is something you see very frequently on SPX. Could you see the flow of money switching from Nvidia to another Mag 7? I don't think any of the other Mag 7 have the hype to support those kind of flows, right? Nvidia does. I mean, currently analysts are pricing Nvidia like it is the end all be all of all things AI for the next 10 years, and they will have and will continue to have exceptional earnings that beat by a significant amount every quarter forever. Um, I don't really think that case can be made for any of the other Mag 7 stocks. So when Nvidia sells off, we do see, we will see other money flow into other parts of the Mag 7, but I don't think it's necessarily equivalent, right? Because you have all of that passive investment money, and that's going to get distributed out more. mm, yeah, it's not necessarily going to get distributed back into the Mag 7, right? We might see it more dispersed, like across uh more underperforming sectors. Like right now I think we're seeing a lot of accumulation in like commodity exposed equities and energy, and that's probably the first place we're going to see hedge funds run to, because if the AI bull market narrative is false, then everybody needed to be in commodities yesterday. Meta. So Meta actually started falling a little bit this week. I think it's the first time that I've seen any significant amount of like call side options interest pull back on it. But we are seeing overall delta on Meta come down pretty significantly. We've seen bot calls fall off, and delta's starting to pull back, but again, still positive. If Meta loses the 480 level, it'll be the first time that it's tripped any kind of bearish signal um, since like December, like early December of 23. So far it's mostly stayed in a very positive range. But yeah, this is the first time it's coming close to kind of coming down. Um, so this one actually might be a good short. Obviously Meta could do with a bit of a pullback. But I'm not sure how far that would go. Gamma neutral is and delta neutral are both down around like the 368 levels. Um, and this is where a lot of like longer dated call positions had been sitting. I think, let's see, GN's at about 380, DN's at 368. So back here, right? This is where like delta and gamma neutral are sitting. If this were to fall back to those, I mean, that's a huge move. It's almost $100, maybe more. Would the gentleman like some veil with his PBR? No thanks. So I'd watch that level on Meta this week. If calls don't come in to support this, there's a very good chance it could lose that 480 strike and continue to fall. Call credit spreads on Meta for this week. I feel like I'd want to take something more aggressive. But yeah, maybe a start, or maybe like a back spread. That way you can hedge off the possibility of the big AI event causing another pump. Is there a good entry point for T? It feels like it keeps going up lately. I mean, I generally try to buy T below this range, but I mean I think even now I still have standing buy orders at 1650. I think 1650 is a very fair price. I've bought as much as I feasibly could when it's traded below 15. It doesn't stay there very long in the two instances that we have gotten prices that low. But yeah, I mean, I'm pretty happy buying on the lower part of this trend for now. I'm gonna keep drip going, probably up to like $20. I might cut it in half around like 1850. If you go back to my original DT, I have like all the valuation stuff in there and why this was like my buy-in price range. But anything below my buy-in range, like this is my DCA range. Anything below that, I'm pretty happy with. Unfortunately, due to like the lead lined pipes thing, and the big miss by the the big miss on well, the expected big miss on earnings here when they lowered guidance. I've gotten like a couple. This is the lead thing. I've gotten a couple really good entries. Um, Obviously, if something happens or there's like a big market correction or something like that, that might open up that like $16 to $14 range again. Otherwise, I would say that I wouldn't expect it to fall that far if things kind of progress normally or in a stable way. Anyway, back to the Mag 7. Microsoft. Now, remember that this one isn't heavily influenced by its options positioning, but largely because it's such a mature company and volatility is pretty low on it already. Delta and Gamma are both still positive here. Call interest is pretty flat. There's a decent amount of charm that came off this week, so it may fall. It kind of may fall as low as like the 400 405 level. Um, Especially if markets pull back, like indexes pull back tomorrow or continue to pull back. But for now, I wouldn't expect it to fall much further than that. And if it does, it's not going to be driven by options. It's going to be driven by people selling it. We got Nvidia and Tesla still left. All right, so Nvidia actually did drop a pretty fat chunk of fucking delta here, about 33 billion falling off on Friday. Prices under 878 mark a continuation in the bearish price action. A fairly significant number of calls fell off and a decent number of puts picked up. However, I wouldn't touch Nvidia this week because of their event in San Jose for AI. There's going to be like 125,000 attendance. I think even more are watching it online. It's probably going to be risky, right? We don't know what's going to be said, and even worse, anything said doesn't need to have any substance in order to create a run on Nvidia, right? They can just bullshit. Any bullshit they say could drive prices higher. Nvidia's revealing their B100 chip, which is very, very far from production, but it's going to create a bunch of hype. If anything, maybe something with upside exposure that is hedged off to the downside would be better. That way you could capture any spike in FOMO, but you don't lose money if it continues to fall. Tesla, which is just looked like a bag of shit. Stabilized against the 160 strike on Friday. There's some support there. I don't think really Delta. I mean, like a little bit of Delta fell off, a little bit of Gamma picked up on Friday. I don't think that the support on Tesla is developed enough to say with any kind of certainty that it's going to persist as a support, but I would say for now it looks like it's found some. The longer it finds support here, the more likely it is that we're going to see bears take profit, right? And that's gonna strengthen the support. So I would say that if it holds this level into tomorrow, Tuesday, there's a very good chance that we'll see some put side capitulation and we'll see prices go up. I'd be looking at like the 175 level as kind of the peak there, with 160 as support to the downside. Is it regarded to consider a service like Tradedics? I mean, Tradedics is fucking useless. I appreciate the data from SIBO is free, and I've learned how to extract and make use of it, but I don't always have time to do the steps. Yeah, that's fair. There's a lot of number crunching that goes on. I personally don't like Tradedics very much. I think there's probably some better services that are less money. They're pretty expensive for, given that they offer literally nothing. And they offer it up super slowly. Uh if you've ever done their trial, their fucking platform takes forever to load when it loads. And then, if you're researching stocks at night, very frequently you won't get like the options information. Did you see QQQ underperforming SPX this week? Well, we'll go into the indexes here in a minute. I'm gonna run over and grab JFresh and Dork, and we'll start talking about that shit now.
Figure out how to fix that, but anyways, in the end, when I put it in my butt, the a lot of the problems went away. So I just kind of said screw it and left it in my butt.
What's up, guys?
Got him.
Hey, Girk, how you doing?
Hanging in there.
What's the flavor of the week in terms of pickle jar sentiment?
I think, well, based on the SPX chat, everyone's a little too bearish. But I have a hard time faulting them.
Well, they're the only people on the planet that are bearish.
Yeah. Well, frequently we find ourselves in that position, being the only bears. It's nice. I mean, we get more room in the cave.
Yeah.
True. I mean, the one thing that's making me extra bearish right now is that last daily candle on SPY. It is a very, very gentle gravestone doji, which I find to be quite interesting.
I hate you.
Do you find it interesting? Can you explain why you find it interesting? Tell us more about the gravestone doji and how important it is.
Well, it indicates that there was a lot of disagreement in the pricing after a gap down as well. So you could almost call this an inverse shooting star doji.
Oh.
Jork, if you say one more thing about candlesticks, I'm gonna mute you. I don't know if I even can mute you in this Discord, but I'm gonna try really hard.
What's its astrology sign?
The Ziblet.
Okay, I could do that.
All right, never mind.
So as long as what you're saying is that when we go into a gap down with a gravestone doji that looks like a shooting star doji that has the astrology sign of the Ziblet, then what? What happens?
Well, it depends on which planets are in retrograde motion.
What percent of the time does something happen in the future?
60% of the time, it happens every time.
Oh shoot! Now you've officially become that Ryan dude on Twitter.
Okay, he genuinely pissed me off when he said that with a 60% home ownership rate is the cost of housing really that important of a metric. I was like, fucking tell that to the 120 million people you're saying don't matter.
Well, they don't. They
I
don't have
mean,
any fucking money, right?
there's a lot. Yeah, there's at least half the country actually just doesn't matter from an economic perspective.
From an economist perspective, but I mean, if those people just stop spending money, the entire economy collapses because they're the only people putting real uh, product into the market or buying real products, right? Like food,
Yeah,
things you can
yeah.
touch.
Obviously, I was being
Yeah.
dry humor. Yeah.
So
All right. So we want to talk about the market crash tomorrow.
This is the. Can I say something from a technical analysis standpoint?
No, this is not
No,
your
fuck.
show. This is
Yes,
our show.
bullshit. Listen to me. All right. This has been the first week in the last 9. Yeah, in the last 9 weeks that has not formed a higher high.
Well,
yeah,
we've
that's
got it.
the most
We've got
embarrassing
something to aspire to this week.
Bullish.
I mean,
Yeah, it's
This is
interesting.
if that's your definition of a pullback, then yeah, that's hella bullish.
Yeah, I mean, from a technical perspective, this is a healthy pullback so far. So far. Only because we didn't close the week below 511, 5111. If we closed below
monthly
5111,
chart.
this would be a bearish pullback. What?
If you zoom out to the monthly chart, I would say we're entering a period of consolidation.
The monthly looks fine. It still looks bullish. It doesn't even look like it's consolidating. It just looks bullish. This month would need to close below 48.53 for anything to be even remotely bearish on the monthly. I mean, have you looked at this fucking thing? It's just going straight up.
Yeah, I mean, it looks like
It's like
Moab.
5 fucking consecutive months of just up.
Yeah,
It's like 2021
only
all
up.
over again.
Yeah, except we did a whole year in 5 months. We just supercharged it because we took everything that everybody learned and was trained to do in 2021. That everybody pulled back expecting something bad to happen in 2022, and then 2023 rolls around and everybody, the Fed's neutered and nothing works as anybody expects, and now we're back to the Wild West, and all those people in 2021 who like dipped their toes into this raging greater fool game just jumped right back in even faster this time.
So one of the funniest things that I see on social media is this discussion that the Fed has achieved a soft landing, and it's hilarious to me because any pullback in economic growth in 2022 was purely an emotional reaction by businesses because they didn't know how higher rates were going to affect the economy. And so now we didn't even have a landing. They were still, decently capitalized. And the market is pretty much directly reflecting that we did not have any sort of semblance of a landing. They just went back to their normal business practices.
Yeah, we already have. I mean, even the housing market, with the higher rates, and everyone was just kind of waiting, hoping for something to happen. Now they've all abandoned that. Now they have to FOMO back into the market, and that's kind of what's happening a little bit. So,
Do we want to talk about annualized CPI moving rapidly towards 4%?
sure.
Okay.
Bud, it's Bud. Stop putting it up.
I mean, now we have productivity up and inflation up. It's like double inflation.
Yeah. Well, can we put the productivity in quotation marks?
Yeah, sure, of course.
Yeah. I
We
mean,
we
the
could
story's
just
kind of the same. I was just updating my this morning I was putting in new values for CPI and wages and something else. Oh, all the GDP numbers for this last year moved a little bit, but almost imperceptibly after some revision. One interesting thing is that
They moved up.
yeah, they moved up very
Yeah.
imperceptibly, like third digit kind of change. But the debt, the government debt, is kind of been flat the last 3 weeks or so. I think probably as people start paying some of their taxes. So we'll see.
We also
We'll see how
have
that goes.
like a lot of maturity rolling off right now, right?
Yeah, so it'll be interesting to see. I mean, the deficits are still growing way too high on a yearly trend basis. So we'll see. Basically, just kind of waiting to see how much Yellen has undershot or overshot her estimates. If she's undershot and has to raise stuff, that's a big deal. But anyway, I was updating all that, and it's still kind of the same thing, right? Deficits are growing at on average 6 to 7% of a year, and the deficits are now larger than the growth of our NGDP, right? So the absolute value of the deficit is growing faster than our economy. Um, and wages are still growing at about 5% a year annualized, which is kind of pegged to this rise in the deficits. And then CPI is coming in, 1 to 2 points below that on a yearly basis, headline CPI.
Yeah, so
And
if we're
I
running
think
if
that's kind of how it's going to be, right? So if we're at, if government spending's at 7 and GDP's at 6, wages are at 5, CPI's at 4, and that's just kind of going to be a continuation of what happened before the pandemic, where our deficits were only going up like 4 or 5% a year.
yeah, I'd see GDP now seems to have been revised down once again on the 14th to 2.3. But I feel like every quarter we get this pullback and then earnings comes out and then GDP shoots up to like 5%. Um
Yeah, that's still an NGDP of close to 6, right?
yeah, it is.
One thing I found interesting was the revised job numbers. I'm pretty sure they got revised down a whole lot,
Interesting.
like
They
40%
did
different.
they did for California at least. I saw
What
that.
on non-farm?
Yeah.
Interesting.
California only added like 50,000 jobs all of last year or something like that. They revised it way down.
Jesus.
Yeah, I don't. I have a bone to pick with this whole thing with revisions and job numbers. Like, if these revisions are so much, like, if they're so huge, right? Like, if the variance of the revision is greater than the mean of the initial measurement, why do you even have the initial measurement in the first place?
It's all theater. It's the attempt to create control of a very complex system, right? And they're making a valiant effort, but at the end of the day, they don't have the accuracy or the timeliness in the data to do anything, right? I mean, you think about like the Fed, and I've talked about this. I think I started talking about this well over a year ago now. Is it even possible with the way the current monetary system is built and how the Fed functions? Is it even possible for the Fed to dampen the response of the economy, or are they doomed to just cause it to spin out wildly anytime they try to make changes? Because they have uncertainty in their measurements and their lag time on how they can respond is so delayed. I mean, you look at like the last 3 to 5 months. The Fed has changed nothing, and the economy has gone from people were somewhat tightening back in October, and think people were scared. Sentiment was definitely, and sentiment helps drive risk taking. And then within the span of 2 months, we just shot to the other extreme with the Fed changing nothing, right? And so, and the Fed's trying to talk about, well, if we don't want to be restrictive for too long, because then then we'll act too slowly, so we want to try to start pulling back too soon. And I think all of that is just BS theater, right? I mean, if your economy can swing from one extreme to the other in 3 months, and you can't make a decision in less than a year, because you really need year-over-year data and trends, right? They keep saying more data, more data. Is it possible to even dampen out that response? I think it's not. And so they're just creating more chaos, right? They're just adding to the volatility. They're not actually dampening anything. So I don't think soft landings are fundamentally possible, or at least to the extent that the Fed can orchestrate them.
Yeah,
I don't think the
I mean,
Fed can do anything in terms of controlling the economy.
well, clearly they can't. I mean, otherwise, even if there was a bounce in economic growth, if these interest rates were to affect it, it wouldn't have been as violent as it has been.
Okay, so my only problem with the Fed has no power narrative is it's not entirely true. They can still roll off their balance sheet faster, right? Instead of just rolling
Are they?
off like, I mean, yeah, right? They can
Okay,
sell,
well,
they can
yeah.
mark to market securities.
This is a
That's
good
always
point,
in their
though. Is that
back pocket.
I'm not saying the Fed
Never
has
going to
no
leave their back.
power. I'm not saying the Fed has no power to uh, influence the economy. I'm saying they don't have any power to control it. They can't. They can't take something that's going out of control, either too hot or too cold, and meaningfully move it back the other way.
Okay, I agree with that. Yeah,
That's
very
what I'm
very little
saying.
power.
They
Okay,
can.
yeah,
They can
very little power over
certainly.
sentiment.
Right. They can certainly uh, try, right? But ultimately, they're just adding fuel to go in the other direction. So, like, if the economy is going too hot and they raise rates 5% and then hold it there for 2 years, right? I mean, all that's really going to be doing, it's either going to be doing nothing, or it's going to be putting so much pressure on the system that it's going to swing back the other way, and they're not going to be able to time it. And so it's just everything's going to go way too cold, and then they're going to have to reverse, and it's just going to be this mess until it blows up, right? And so I'm saying the economy is fundamentally an unstable system, and when it starts going unstable, the Fed can't stop it. They just feed it.
And the
Yeah,
way I see it too is not it's not a question of if they have the power to do something and to affect the economy. It's more so that do they have the stomach to do what is necessary for the economy? And I find that to be highly unlikely no matter who's in charge of it, because you have a dual mandate, right? Maximum employment and stable pricing. And so to do, what may be necessary to return us to monetary stability, such as rolling off the balance sheet more aggressively, could end up imparting a bunch of human suffering and violating your dual mandate. Regardless how you feel about the dual mandate, that's what they have to follow. So for
But
me,
I'm saying that the way that they collect the information, it's so delayed and it's so imprecise that they can't actually durably, stably control those targets, right? We're always going to oscillate.
but what they can do is they don't have to, like, the whole binary narrative of the Fed is kind of silly, because they could do things like roll off the balance sheet and keep interest rates low at the same time, and then raise interest rates when their balance sheet is low. Like, you can do that, but for some reason, we have this mindset that the Fed has to increase interest rates, put stress on the banks, and then offload their balance sheet, which is just pure dropping a nuclear bomb on the economy, instead of, say, putting interest rates back somewhere reasonable like 3%, using that time to offload their fucking shit bags. And then once their shit bags are done, the economy's still doing okay. Then they're like, all right, let's start raising interest rates. And just you could do it that way and keep a more neutral stance, in your policy, and not just have to do this thing where we're constantly like, the economy's growing too fast, we got to tighten. Oh, the economy's slowing down too fast, we got to loosen, we got to buy assets and fucking cut interest rates. We
hold the
can
fuck
do
up. Dork, are you suggesting that the Fed manipulate interest rates to the benefit of their balance sheet?
That's exactly what I'm suggesting they do.
I mean,
exactly.
you do realize that nobody would ever buy another U.S. security again if the Fed did that, right?
You know, if they did that for a little bit of time, it would put America in an amazing spot.
I mean, they should have just rolled off their fucking balance sheet when interest rates were low.
Yes, exactly. Yes, they should have. In 2021, they should have started rolling off their balance sheet sometime in like September.
Didn't they try to do this before the taper tantrum? I'm trying to remember all the
Yeah,
specifics of
yeah,
the
they
taper
Yeah.
they tried
tantrum.
they tried to taper back in 2018 or was it 2016? One of the two, and
And it
they're
was like a baby taper compared to nowadays, and everybody just started throwing a fit, and the market didn't like it, and they're like, "Oh, well, the wealthy's assets can't go down. That would be terrible."
yeah. No, it's fucking stupid.
And so, and now, fast forward, almost 10 years, and my 2,900 square foot house is worth almost $1 million somehow.
Yep.
No, we done fucked up. Like there was a way to responsibly, taper back our balance sheet and not listen to a bunch of people who only care about their year-over-year returns and their fucking mega corporations.
Like what honestly would be, I mean, what would be so terrible if the S&P 500 was just half the value it was today?
Nothing.
401ks
Nothing.
gamble.
I mean, you'd lose the wealth effect.
Yeah.
Yeah.
So the consumer would be significantly less resilient very, very quickly. We'd have, I mean, the problem is once we lose any substantial amount of valuation in the S&P, everything else is going to be set on a path of decline over the next like 8 months, right?
I get that, but what if instead of having these ridiculous 50% runs and then massive declines, what if we just didn't have those crazy runs?
I mean, you'd have to get rid of the incentive, which is like shorting vol, right? I mean, you can make volatility not a tradable product.
I think all you have to do is just keep raising interest rates.
Just keep pumping them up.
Yeah, just keep going up until the stock market stops being a piece of shit.
Volcker them. I mean, we're not even at a fucking neutral rate now. I mean, that's the most embarrassing thing ever, is that in November we were just slightly restrictive, and now we're not even neutral.
So how do you come about that?
What,
Because the
neutral
Fed
rate?
says we're restrictive.
I mean, we're
And I
restrictive.
presume
We're
they're just
restrictive
looking at
based on the
CPI.
last CPI numbers they commented on. But I'm looking at annualized supercore because I assume that's what the Fed's looking at.
Yeah.
And that's well on track to being above 4% now, with the federal funds rate at 5.33, right?
Yeah.
Now in November, that was around 3.2, which meant the rate was still slightly above their long run goal for inflation, right?
Yeah.
I mean, and you could break it down sector wise too, and
Because
just look at
that would have been like a 2.1 spread. Right now we have like a 1.1 spread. So I mean, personally, I think due to the rise in inflation in the last 3 reports, the Fed needs to raise interest rates by 1.
So what is the argument to say that the neutral rate is inflation?
I think the neutral rate should really be determined from producer prices, but just in the generally accepted practice, it's said that your neutral rate is the Fed funds rate. It's CPI minus Fed funds rate, or Fed fund rate minus CPI. I forget which one.
Yeah, I understand that, but why?
It's arbitrary. I mean, I think a better way to do it would be GDP growth, right?
Nominal or real?
Nominal GDP growth.
Yeah, I kind of agree actually.
That would be way more accurate of a measure of how restrictive your policy is, because if your interest rates are higher than NGDP growth, then you're talking about a restrictive policy.
And there's really no question, right?
Yeah, yeah, exactly. But like when we go with like CPI and shit, those baskets change. Different sectors are more restrictive than others too. Like, so, if you look at, like the CPI of like the transportation industry versus, food, you'll see a very different picture of how restrictive the Fed funds rate is, right?
Yeah, and I agree. And you might be obviously it's likely a more conservative estimate, so you'll probably be a little bit more restrictive than you think you are at all times. But is that so terrible? I mean, if you look at all the just the pump and dumps that our whole economy just is constantly engaging in this unrestricted environment. I mean, if you really wanted to tamp down long-term volatility, I mean, wouldn't you want to be a little bit restrictive at all times?
Ideally, yeah. I mean,
It's just unpopular, right? I guess that's the challenge.
let's
When
say,
when the president of the United States calls the Federal Reserve that little outfit and says things like that little outfit is gonna lower the rates out on the, it's just like I cannot think of a more like, I mean, everybody talks about, yes, Trump is a piece of shit. He paints his face orange every day and nobody discusses how weird that is. He's losing his mind and he's a dictator and there's questions of whether he's ever going to cede power if he gains it again. Sure, the death of democracy might be at stake. Sure, okay. But when like the current president says something like that about something that's so vastly important to like the world economy, I feel like that is probably as dangerous, if not more dangerous. Like that is not a great thing to say, and just like the denigration of what the Fed is.
To even imply that the executive branch has power over the Fed is, I mean, there's implications there that are already very concerning.
Yeah, I when I heard that quote, that one really bothered me. I mean, a lot of the stuff is just stupid. Biden talking about going after shrinkflation and McDonald's frosty machine. Well, that's Wendy's. McDonald's McFlurry machines and some other weird stuff. Whatever. He's an old guy. He's trying to pander to.
Other old people.
Yeah, but like, yeah, why would you say something like that? That's just really brazen.
yeah, yeah,
Because
it is. I don't.
Bidenomics, man.
So let
What's
me
your
tell you.
beef with Keynesian economics? Keynes fails to consider the negative effects of government spending on levels of aggregate demand, and it's always going to be a flaw. And it's why Keynesian backed policies and programs have failed every fucking time since the acceptance of Keynesian economics as the one true economic philosophy. It's
I mean, at
garbage.
this at
They
this
should be
point, can we just
avoided at all costs.
at this point can we just? I think we could all acknowledge at this point that there is really no good theory out there for a lot of the monetary effects that we've been seeing.
I feel there's
At
some.
least not a single holistic theory. You can take pieces of a lot of different ones
Yeah.
and come to
You could
some
say there's no
conclusion
grand
that's
unified
consistent.
Well,
theory.
we're in a novel. Inflation and government spending and stuff right now are kind of in a novel
Yeah,
cycle, right? Like we've really never seen it all come together exactly this way before, right? But
right.
we've seen
I
each phase of it occur in the past, and so that, yeah, I mean, you have to cobble a few economic theories together, but the Fed really doesn't do that, right? Like the Fed is,
no.
it's Keynesian economics through and through. So is the U.S. government, and
The Fed's still trying to fit the fucking Phillips curve to all the shit that's happened. which
Yeah.
that is a piece of garbage. I don't know what school of economics that comes from, but it's absolute garbage.
Yeah. Oh, I mean, it's a terrible way of assessing future information, right?
I mean, you look at people that are just like, oh, now the Phillips curve is flat. It's like, oh, now it's really steep, or here it's nonlinear now. It's like what you're showing me is that there is no clear correlation between these two things for which you can build a theory on top of. Yet here you are, just trying to add more and more fudge factors to this existing idea until it fits all of the data, and it's just become a mess. And then you start getting weird things like, what are inflation expectations? And okay, that's fine, but if you go and look at inflation expectations, they lag. They lag actual inflation. And so obviously it's not part of the driver, even though the Phillips curve assumes it helps drive inflation, and that it ends up just being another fudge factor they can put in to help fit the data, but it doesn't make any sense. And then you have other things like, they assume that earnings margins for companies are constant over time, and they clearly were not during the pandemic and the subsequent expansion, and that's not accounted for at all. And so of course they don't show a demand driven accounting of, right, because all their terms are supply, and so they're going to fit these terms, just these supply terms,
Well,
because they're not, but they're not actually capturing. It's not consistent with all of the observations, and it's actually inconsistent with a lot of the observations. And so
well,
yeah,
you just
I
hope
dug in.
you just hope to smooth it out, right?
Yeah, but my point is that the theory, a theory is only as good as how well it can consistently mirror or explain reality, right? And so the test of a theory is not how well you can get it to fit to some data. The test is what,
You're
how hard is
doing
it to break
you're doing
break
that
it?
thing
And
again.
it's not
Stop
very
trying to
hard
make
to break.
economics a science.
Uh,
It's not a hard science. There's no method applied.
all I'm saying is it took somebody, me, who didn't even know what the Phillips curve was like 2 years ago, to spend 2 months reading about it and looking at papers and thinking about it, and it took me almost no effort at all to break it. And that tells me, from a science perspective, that it's not a very good theory.
It's not.
Well, nothing in
That's
economics
all I'm saying.
theory.
Yeah.
I mean,
That's
supply and demand even is as a theory it purely exists in a theoretical space. Like
Yeah.
I mean, you can apply to supply and demand to like microeconomics, but on a macro scale, there's too many moving parts, right?
Yeah, it's really hard to in that case, it's just really hard to quantify. Yeah.
Exactly, yeah. Like, what is aggregate demand? What does that even mean? You know?
It's your mom.
I know it is, but
Got
she's
him.
always an aggregate demand.
Have we lost anyone yet? I mean,
I
I've
don't
just been
know.
bitching
Maybe
about.
bitching about the Phillips curve should have. Nope. More people.
Son of a bitch. God damn it.
Yeah, we tried. I mean,
People
at
do
least
not like the
they're
Phillips
not
curve.
liking the stream, but they're listening to it.
Oh,
Ooh,
all right.
here.
Hate
Here,
watchers are the
let
best.
me, I
Yeah.
got something. I got the poison pill.
What?
So, did you hear about the law that was passed regarding home sellers not having to pay the commission for buyer's agents?
Yes. Yeah.
What are your thoughts on how that's going to affect the housing market?
I mean, there's going to be less agents.
I mean, we already have way too many agents, right?
I mean,
That's just
It's
a
going to
fact.
increase the number of people actively working on Uber.
I mean, can you think of a more lucrative job that requires like no actual intelligence or skill?
it
There's a
depends on
one.
who you're dealing with.
I
Like,
mean, in a lot of states, like, the broker's representation of your rights is middling at best. There are some states
So,
that really push the fiduciary duty, but very few of them do.
so I'm pretty ambivalent on this because my agent for the house that I bought, she was fucking awesome. Like she put in at least a couple hundred hours of work on our place, right? So and not just this place, just like showing up places with us and all these things, all with no guarantee that we were ever going to get a place and all this shit. At the
Yeah,
same
there's a lot of
time, though, I'm like,
opportunity cost.
right, right. But at the same time, I'm like thinking to myself, like, okay, so we're talking, like a 6% or whatever, 5%, commission on a house, but that has stayed static throughout the years, and because it keeps up with the price of housing and not with the CPI, the net value that you or the net income you make per house as a realtor has grown significantly faster than inflation, right?
Yeah.
So, I mean, it to me that is there is moral hazard there because as a real estate agent, your like overarching goal, even if you're for the buyer or the seller, doesn't matter, is to make those prices go higher so your commissions go up. And I'm hoping that what ends up happening is buyers agents in particular go to more of a flat fee structure or at least get into some sort of agreement on a capped fee. And that's how they can maintain their business. But like new realtors who can't figure out how to do that shit are fucked. And yeah, they're gonna die.
I mean,
But
real estate agents are like the definition of moral hazard, right? Like they're a fiduciary agent with a contractual obligation to one of the two parties, right? And they're still selling the homes.
well, I don't see. I don't. If they're on both sides, then yeah, there's extreme moral
No,
hazard.
They're
no,
all
that's
on
no,
both
no, I
sides.
mean, yeah, that's that. I'm not talking about buyer's agent, seller's agent. Nobody should be advising anybody to buy a home in the current market ever, right? So, I mean, they've already failed at their
Well, they don't tell
fiduciary
you. They don't.
duty.
They don't tell you to do anything. You can have them show you a bunch of homes and then just not buy one. All they can do is what you tell them to do. Like they can't like you can't like they can't say oh like you should buy this house or anything like
But
that.
then
They
you're
can
They,
saying that
they
they're not your
absolutely they
fiduciary.
absolutely say that though. They
but they won't.
absolutely say
They
like
can't
you
go and
should
buy
buy
a
this
house on
house.
your
This is
behalf.
exactly what you're looking for. What a great deal. Look how low rates are. They're only going to go higher.
But they can't buy a house on your behalf.
No, no, they cannot.
And and at any point too, you can negotiate your commission rate with them. And they all they can do is what you request them to do or to facilitate the process that you yourself have willingly entered into. So
I
I
don't know.
mean,
I'm never moving again, so I guess I don't care anymore.
You
I
can't
just
move.
I
I
think
can't.
You don't even have a fucking choice.
Well, I could move, but I wouldn't like it.
No, no,
I've
and you wouldn't be able
I'm
to. You
in.
wouldn't be able to brag about your mortgage every week either.
Yeah, that's true. The nice thing though is that I moved right before all this, so I'm in the space that I plan to. I imagine like what if I didn't move and I was still stuck in the with three kids and five animals in like a 1900 square foot home. It would have been miserable. Doing the stupidest thing I could have done was the best decision I've ever made.
This is why we don't let you day trade.
uh,
Well, unfortunately, I haven't had any time to even mess with it at all. It's been sad. I've been really busy this spring.
but yeah, so I mean, I don't know. I think it's going to be good. I'm hoping that it's not some play by like Vanguard and BlackRock to just further corner the whole buying and selling industry.
I still think largely that in all of this, many people are ignoring the effect of like fixed income funds and like all of these call selling ETFs and like all those passive investment flows. And I think a large part of that is still driving much of the valuations we're seeing. I mean, I've been paying a lot more attention to Nvidia, for example, over the last like 3 weeks since I started selling straddles on it, like specifically its options chain. And Nvidia is just a constant series of like all of its price improvement for the most part is just a constant series of like squeezing out short call positions and moving substantially higher levels on the back of these like mini squeezes. And those short call positions are largely ETFs that contain Nvidia and actively sell calls on their shareholdings, right? um and it's just like that. I would say that accounts for something like 20 to 30% of the total price improvement on Nvidia since last year, if not maybe even more. And that's going on everywhere. And those funds, like 3 months or 4 months ago, I bitched about this, and the assets under management of those funds had grown from like 50 billion to like 150 billion, and now they're like almost at 300 billion. Like the amount of
leverage is
money getting
crazy.
pumped into those is just exponentially expanding, right? And everyone wonders why everything's constantly going up with zero pullback. And it's because every time we even get a little bit of a pullback, all of those funds start dumping short calls out all over the market, and then they immediately get squeezed out.
Yeah, I kind of agree with that. I don't know how much of that is directly just the effect of these ETFs that are selling calls versus just a larger trend in general. And we also can't discount the absolutely astronomically massive sold put position on the market, which is what is eating into all those sold calls to begin with. But yeah, I mean, sold calls are a big part of what we've seen. Ooh, you want to pull up a chart? I
Ooh.
haven't put a chart on here in a while.
We have a
Remember
chart.
my old SPX VIX correlation chart
Yep.
that I had that I just
Stop publishing.
stopped for a while? Yeah, because it just been flat. Well, I stopped for too long because I went back and looked, and since January, it's in the chat in the Discord chat.
I'm trying to find it. Oh, here we go.
It's the last
I
picture.
got it. Uh, boop. Oh, there we go.
Is it up?
Yeah, let me make this a little bigger though.
Hold on, let me take this opportunity to log into your stream so I can see what you're. Make
You
sure
got
you're
it.
not putting up like a.
It's a penis.
Yeah, make sure you're not putting up a picture of my bare butt.
It's just yeah. I mean, I probably have one of those somewhere.
One.
Well, I'm not gonna break into the collection.
Yeah. Okay. So there's this bad boy. So the top part. That's just my. So I'm looking at trying to pull out long-term trends and just look at the volatile component of the SPX and compare that to the volatile component of the VIX, and it's normalized to try to get them on the same chart. And you can kind of see back in 2022 the correlation was pretty spot on. And then right about the time when ChatGPT started becoming popular, before in basically December of 2022, we started seeing this split off.
Mm-hmm.
But one of the things, I mean, I think that's when all of the selling of options started to become a big deal.
Yeah.
And you can see that it basically would temporarily suppress the price of the SPX, the blue curve, but then eventually will always want to try to pull back up to the VIX. curve, and so you can even see like in November. I mean, one of the reasons I think we rocketed so quickly was just because it was being this upward pressure was being compressed, so it was like a beach ball being pushed underwater, and then we just have been shooting up ever since. But interestingly, we finally reached back to parity between these two things. And if you go and look at the bottom graph, which shows the difference between these two normalized things, yeah, so you can kind of see in 2022 it's pretty noisy. So each one of these red dotted lines is one standard deviation of this data set. So 2 standard deviations is about where we'll push to, and so you can kind of see it was very volatile in 2022, but it kind of tracked it within 1 standard deviation or so, and then you can kind of see where it got pushed down pretty substantially from Jan to basically to November of 2023, and then basically we had like one of the most epic vol squeezes of all time.
Yeah.
All the way up until now. I mean, if I could get more of this information farther back, I probably would rerun this again with more historical data. But I mean, this was a pretty epic vol squeeze that we pumped, and for those that have been around and saw that I was saying like SPX to 5250, Nvidia to 1050, and the SMCI, whatever micro,
No.
super micro, to 1300. I mean, that's kind of looking at this kind of idea where does this vol run out, right? And we got pretty close on all of those, so we didn't quite get there. I mean, I guess we still could, but I mean, what this is telling me is that this vol squeeze that's been propelling us up is kind of running out. And so what's going to come next? I don't know, but it's not likely to be more vol squeeze. I mean, unless people ramp up even more, which we can talk about later as well. I've got some charts for that, but yeah, we're definitely entering.
Well, I've been discussing with everyone a lot, kind of the leverage, right, and how we're seeing leverage break down, and how we're seeing it break down across more macro assets. And I know you focus on leverage breaking down in the S&P more specifically, right, or on the SPX. So we could take a look at.
It's actually the market as a whole. It's most of the options across the market.
Oh, you're not just looking at SPX on that chart?
No,
Okay.
that's all. That's like 220 stocks of the most common, the largest
All right,
options traded.
that's a
things.
lot more useful. That's good.
Yeah,
Okay.
it's more of a market wide. It's not perfect, right? There's thousands of stocks, but most of the stocks, I mean, the actual money traded on the options chains are like almost nothing. So this is still the bulk behavior. Yeah, if you want to pull it up, we can.
Yeah, so over the last few weeks, we've seen a pretty consistent and persistent degradation in short vol. We've been seeing it pull back. I'd say it's been about 3 weeks now, and we've been seeing a constantly higher rate of like cash VIX, and VIX futures has still stayed relatively pinned, but that's been moving up as well. And last week we spent a lot of time discussing the forward yield of vol convexity, and but I think this chart that you made really offers a lot of insight into what that really means in the market. As
I about shit my pants on this chart popped out.
Yeah, this is a pretty good. It's a pretty good one. And it's a lot of what we expected, right? Like we expected a lot of this positioning to fall off with the March Opex. Maybe not this much. This is quite a big move, but here we are.
Well, yeah. So one thing I'll say is, going into this Opex, I've mentioned a couple times, like the setup looked really similar to December, where we kind of like rocketed up, but then and then we went flat afterwards, right? But we had a big drop off in Delta, but we didn't have a huge drop off in leverage. You can kind of see there was a little baby drop And maybe
Yeah,
that was the start of the drop, but this one, I mean, it was even clear back then in like December and January that a lot of the call positions and things were rolling out. Were rolling out to Feb to March.
yeah,
Most of
we
it
were
to
seeing
March.
like everything build up in March. So like December and Jan both saw like a lot of index options, and then in Jan a lot of equity options fall off. And I would say that both times we saw positioning roll out pretty heavily to March.
Yeah, but then like there's it was all still like even on Friday, it's all still at March, and it all just expired,
Yeah,
and
and
it
and
hasn't really rolled. I mean, so there's a significant on the weekly contracts for SPX. There's actually a significant position at the end of March. But other than that, like it just like it all just expired.
how much of that is just the color?
I don't know.
It's a chunk. But yeah. So we're not seeing that supportive positioning roll out, and there have been a few other times, like very specifically, you'll see that call leverage drop off really hard in December of 2022. Was another instance, kind of the end of July in 2023. Um, and then yeah, again, like we saw it a little bit in December of 2023, but mostly, put leverage increased in that period, right? So like even though some of the call side support fell off, we saw put leverage climbing, and so short vol was continuing. Back in December Opex and Jan Opex, short vol was continuing to just pile in as hard as it feasibly could. It wasn't really until um, like the Feb 12 CPI report that we start seeing, or was it Feb 12th? I think it was Feb 12th. And we start really seeing leverage decline everywhere, and we've been seeing, total like Vega exposure on SPX and SPXW trim back. We've been seeing, a lot of the effects of that as we like trade above like Vega neutral, and then we see big chunks of short puts fall off, and that has created a lot of volatility in the last like 3 weeks 4 weeks of upside price movement. And we most of the highs that we've tested, we've seen these big like volatile pullbacks where VIX spikes really hard, and a lot of that is like the action of like the live action of this deleveraging occurring. And now calls are what as supportive, like call leverage is as supportive as it was in, is that November?
Yeah, it's like basically like November, December. So back when we were trading around like 47.50.
Nice. Well,
Um,
that seems
pretty much all the market delta that's accrued from 47.50 to here just like fell off in one day.
So Girk, if you want to give JFresh a better chart, you can just export the CSVs for SPX and VIX on the daily candles, and then just give him those, and then he can use those.
okay.
What are you talking about?
For the SPX VIX correlation chart, he can give you just fucking a billion years of data.
I think I gave
Right.
him that already.
No, that. But I pull from options data as well to yeah. It's based on options positioning as well to try to pull out the long-term trends because a lot of the volatility is driven by options.
You son of a bitch. Of course
Yeah,
you have some extra stuff you don't. You fucker.
it's
Why is
all
this
very
the story of my interactions with you,
it's
JFresh?
all very proprietary and highly sexual.
Every time, like, hey, JFresh, can you help me add 1+1? He's like, well, when I add 1 to 1, I also in between add these extra 25 steps that I forgot to mention the last time we talked about it. It's not 2.
Well, okay. Do you want me to show you how to calculate it? I will. That sounds
No,
like you're.
It's a
I don't need
huge
to know that.
Yeah,
Don't tell me that.
yeah, especially not right now.
I know he just slapped.
Actually, that'd be a great way to get rid of some viewers if we just spend an hour like. Well, I don't know. That actually might draw some people in if we start giving away secrets.
Well, we'll lose 100 and gain 5. That's how it'll work.
So
Yeah.
I
So this
pulled
is
up your gross market delta too, just to.
yeah. So this basically just looks at like how much delta is on the market, and so you think about like the SPX
And this
is
is still relative to
30s.
moneyness, right?
Uh, it's well, moneyness is part of it, but it's just
Okay.
literally just like what's all the delta.
All right.
If you take all the delta for all the contracts on the market and take the value of that delta and add it all up, that's what this is.
Yeah.
And so you think about like the SPX is like $46 trillion and change. We're talking about like basically about 10% of the market of the like the total market cap of the S&P 500 is sitting in delta. And yeah, so like $1.2 trillion, pretty much all in calls, dropped off. What's interesting is that actually the put delta went up, right? And I was telling this to Dork a little bit before. So in contrast to the fact that all of these calls were all concentrated on March Opex, because we have this basically rolling short vol short put position, the short puts are all still there, right? They
Yeah.
were never concentrated at one strike. And so to me, I feel like it's like a steamroller kind of thing, or probably more like a I don't know. It's like I feel like the short put position that's rolling is just somebody standing on the sidewalk underneath a piano that's being trying to be pulled up on a pulley up to like the top floor.
Pennies in front of
And
a steamroller.
yeah. But the cord just got cut on the piano. But the short put position's just like completely unaware and it's just gonna stand there and wait.
It's very exposed. I mean, my real curiosity here is like, are we gonna see continued, um, are we gonna see like a continued drop off where they're constantly selling short vol against declining prices like we did in August?
That's kind of what we saw in August, yeah.
Yeah,
Where
and
they fought it
September
all
and
the way down.
October, they just kept selling and selling and selling and like basically rolling those positions down versus, something like Jan 2022 where a ton of that positioning just got exposed, right? And blown up.
Yeah, so I've been
Someone's knocking. 1 second, I'll be right back.
okay. Yeah, well, can I? Okay, can you guys still hear me?
You can keep your going
Sometimes
on
he
the
mutes us
diatribe.
when he leaves. Okay. Yeah. So I've been thinking a little bit about this, right? And of course, I decided to be a troll a little bit on Twitter and say that these look like great initial conditions for the start of a big move down, like a very rapid move down, which some people might call a crash. And obviously, if one were to happen now, this would be a great time in terms of the mechanics of the market. But I've been trying to think of what has actually occurred after this Opex, right? So you have basically a bunch of calls with a lot of that have gained a lot of value. Um, and those calls now all expired, and so money has changed hands. A lot of money has changed hands. So the people who owned those calls have now received a lot of money. So the first question is who are those people? And then the second question is what are they going to do with all that money? And then you have to think about the other side of the coin of who sold all those calls, right? And what are they going to do now that they had all their money taken away? Was it all their money? Was it some of their money? Are they going to try to recoup it by selling more calls? And so that's something I think that obviously we don't have the answer to, but the fact that so much money has changed hands from short calls to long calls, it signals to me there's a pretty good chance that the tactics and therefore the market behavior is going to change pretty dramatically going forward. Now, does that mean it's going to go straight down? You know, it's anybody's guess, right? But unless people are willing to, you know, jump in even harder, right? I mean, those people that just bought all those calls and profited, they could jump right back in and buy more, right? And then if the people who were selling them, you know, if it's, you know, like Girk was talking about with these ETFs that just sell calls mechanically, if there's this steady supply of call selling, maybe he just keep marching up and we get a whole other leg of this, you know, crazy, you know, bubble inflation. So, I mean, literally what I'm saying is we could either go straight down or straight up or anything in between, which is not actionable in any way. But it's kind of
So
interesting to think about the
so yeah,
mechanics.
up, down, or sideways. So here's my observation on this. If it is structural ETFs that are shorting calls, if they're constantly getting blown up on the short calls, then they're losing money, right? And
Well, they're just not making as much money as they would have if they were just pure long.
Yeah.
no, necessarily, if you're short a call and you
They're
get blown
covered
up that
calls.
short call, what happens? You
They're
pay the
covered
side
calls.
the money.
Yeah, but they're covered calls.
They're
So
not
they're just
even, they're
giving away.
usually not even covered calls. They're like a product that mimics covered calls.
Yeah, or they're like
Yeah.
call spreads or something. But in any case, you're sustaining a loss, and you know it's not a sustainable strategy.
No, I think for that specific case, it's capping your gains, not
Yeah,
sustaining the
it
loss.
caps your gains. You're selling, like, if you're always selling a covered call like 3% out of the money over time, right? Even if you keep getting assigned, right? You're still making money every time. You just limit your gains, so it just caps, like, it caps the total profitability of the fund. Whereas,
All right.
like, you know, if the trend was less steep and you were always selling above trend, you'd be yielding more and making the money on the price improvement simultaneously. Does that make sense?
Yeah, it does.
Yeah.
So in any case, too, with all this delta dropping off, there's you know, it's there's a bunch of market participants, and by a bunch I mean a very small, highly concentrated consortium of market participants whose only job is to make sure that this event goes off without a hitch, right? So you could, you know, they have obligations to be neutral in all these things, but how they fulfill those obligations, you know, ultimately will determine the outcome of, you know, what is probably going to be a volatile, you know, first half of the week, especially heading into FOMC. I think that all these people who took all these profits on all these calls are probably just going to position neutrally with that money.
Yeah, I think that we could see some stabilization, especially with like, even though all that delta dropped off, I would expect maybe markets are going to be kind of stable over the next 3 days. Tomorrow probably has the biggest like, because so much gamma got sucked out of the market so fast. I think tomorrow probably has the biggest opportunity to see like a one big move, and then I think after that we stabilize.
Yeah, it'd have to really slip through though, right? It's still gotta.
Yeah,
There's
we
still got to
still
be
was
like
yeah,
a.
we gotta lose like some major. I think that synth long at like 5,000 is still there. Like, that, just that giant fucking whatever the fuck that thing is. Hold on.
Yeah, there's still a bunch of it there. I think I was looking at the strike by strike. Actually,
Let me
I
look
might
at
have
like
that data
random.
on the twatters. Let's see. Yeah, 5,000. Uh,
Yeah,
maybe
some of it
5,000.
fell off, but
Yeah,
there's still like 1.5 million contracts there. So maybe we slip 5,100, maybe we settle around like 50-50, or maybe even we fall to 5,000, right? If the bears really push this drop off in delta, it's possible. I know like out like in the like aggregate positioning, like puts have swelled enormously to the downside. Um up until like the JPM call wall, like I think gamma's pretty much negative, just all the way down. So it's
Yeah,
possible. It's
we
possible we could like shoot down to that 5,000 level and settle there. But yeah, I mean the next two policy decisions, BOJ and the Fed, are going to be really impactful, right?
yeah, BOJ's Monday night.
Yeah. Oh, I wanted to talk about that too, actually. The BOJ. Really interesting. So Nikkei did their like standard forecasting of some, their secret insider in the Bank of Japan told them that the Bank of Japan is going to move to zero, a policy rate that is 0 to 0.1, right, which is effectively a 10 point increase, right? But um what's interesting about that is anybody leveraged into the carry trade now can still maintain a 0% rate policy rate, right? But in order to do that, they're going to have to buy a lot more Japanese bonds. And I thought strategically that was a really interesting, like, instead of just going to point one, right, and having that positive rate locked in, they're offering the opportunity for a flat rate, like a 0% rate, should those participants lean more into JGBs.
Hmm. Just want to burn it all with fire.
I mean, but you still, well, there's still a margin loss, right? I mean, as far as leverage goes, there's still a 10% shift, right?
Yeah.
So, I mean, some losses are going to be seen, but then, I mean, and that might not be true, right? We might get a different decision out of the Bank of Japan, but that is the rumor.
The rumors tend to be true.
And I think if the Fed raises rates in response to the shift to a 0% rate by Bank of Japan, that should prevent any kind of like massive shift in due to the loss of leverage.
Could you imagine if they've raised rates though?
Yeah, I mean, what, would go back to 4,200? Like, just like nothing's fucking changed. I mean, we probably won't even do that, right? We'd probably fall to like 46 or something. The fact that we're trading at these prices, despite the fact that, Fed fund futures are pricing in 60 points of cuts now, is ridiculous, right?
Yeah, well, I mean, I think a lot of this, I
AI.
mean, I think this was, yeah, sure, but I think a lot of this was set in motion months ago, right? And it's still taking time for it to bleed off, right? Those existing positions and that existing momentum, which is why I think that the huge delta that dropped off this Friday is interesting, right? In terms of, I think we're going to see a change in regime. I think we might be at the end of just straight up, but we'll see.
I mean, it all depends, right? Like, the market itself is gonna all these participants that like I said that took all this profit, right? They're kind of in the driver's seat right now, and unless the Bank of Japan does something super crazy or interest rates change in a super volatile way in the dot plot, then I mean there's really no reason why the market wouldn't just continue marching upwards.
I mean, the Fed definitely needs to revise the dot plot at this meeting, right?
They
I don't
do,
even
but
think I don't like if even if they stick to like their announcements about a June cut, that only gives them two for the year.
yeah, but if they're largely in line with Fed funds futures, then nothing's going to happen.
Fed futures are still pricing in three. I mean, well, slightly more than 2.
That's why I said largely.
Yeah.
So if they basically statistically their dot plot shakes out exactly like Fed funds futures, yeah, then nothing's going to change. So, and I don't think the Fed necessarily wants to go and create a bunch of disruption in the debt market, even though that may or may not be the best plan of action.
I mean, they may not have a choice as far as the rate increase goes when, compared to Bank of Japan. I mean, I assume they're informed, right? Like, maybe they're not, but I assume that they would be very, very informed of the effect of Japan raising rates 2 days before them. Um, and I think, I mean, in order to promote stability, that they would be encouraged to raise rates as well. Maybe
If they
not a
did, that
lot.
would be
Maybe just
well,
match it, just 0.1, right?
that'd be such a huge tell if they did that in response. That would tell you where their mind is at.
Yeah,
Like
yeah, I would.
and I don't know if they necessarily want to telegraph that hard. I feel like they're just not going to do anything besides revise the dot plot and say they're going to remain data dependent. And
Well, the
yeah,
revisions to the dot plot are what matter, though, right? Like, if there's a really good chance, especially after the last CPI, that they can't make a case for 2 cuts this year, right? Maybe not even a case for any. And depending on how extreme that swing is, um, that could obviously impact everything pretty dramatically, right? I mean, if Fed fund futures have to go from pricing in 2.5 cuts essentially right now to pricing in 0 or even 1, that's going to be a huge shift. And let's just focus on the vol, right? Like, in Vega hedges are going to have to increase quite a lot.
Rova hedges are going to have to increase.
Yeah, that too, because they're planning on pulling that back, right? Or currently.
Yeah, I do think Rova had a hand to play in the initial bump from November to like December, and then it
Yeah,
just
because
sort of
all of a sudden they can just close all of that put positioning, right? Like, all
well,
of
what
that
it did
long
was
put positioning.
it priced up calls, which required hedging, right? And so then you just start buying to hedge the interest rate the change in the interest rate exposure, which which I think was part of that, blow up. And then of course that turned into all sorts of other momentum things and sort of transformed into other, Gamma, Vega, and Vana, all that shit. But
I'll humor Fear and Loathing in Las Vegas because he's written an entire paragraph here. But out of curiosity, why is the thought that short puts will get run over? If we look at past Black Swan events, vol doesn't spike out of nowhere. So as vol increases leading up to a Black Swan event, the short put premiums will also increase substantially. Maybe different for far dated short puts, but most that are discussed on stream every day seem to be short dated. Well, they're never short or far dated, right? The majority of the puts being sold on any given day are within the window that shorts VIX, right? And so in order to lower the price of cash VIX, you need to sell between it's actually between 24 and 32 days, right? The way they define it's like 23 to 34, I think, but it's actually 24 to 32 is where they have to be sold. Besides that, so there's always a constant position being sold within that auction window, and that's always rolling, right? Because it's always being sold in that window. As the older window, every day the older window drops off, and those puts fall off, and new puts are sold. Um, And so, yes, put premiums could increase substantially, and that's what we saw with the spike in volatility in August, was that put premiums increased substantially, and so puts continued to be sold into the downside, which wasn't very aggressive, right? It was kind of a slow. We lost 15, almost 15% on the index, which is actually huge, right? That's almost a bear market all by itself. But it was lost very, very slowly over time, and largely, yes, because vol spiked and those premiums were more substantial, and so they kept rolling the position down because they didn't think that there was any risk of a crash, I assume, or at least, they weren't going to abandon that positioning without at least guidance from the Fed that, told them that they needed to. And then when the Fed reversed course, that paid out a lot for them, right? But where did I want to go with this? If the drop is fast enough, right? If it occurs quickly and vol spikes very rapidly, then we could see those positions exposed and squeezed. So it really just depends. But that's kind of why we're highlighting, all of that supportive call positioning fell off, which could beget a large move to the downside that could pressure those positions and immediately put them underwater. And you can't leverage up more when all of your other leverage is fucked, right?
Yeah, so just to add to that too, we have not had zero DTEs for a very long time. I mean, like every Friday there were zero DTEs, right? That was what was happening in the past. But now we have a continuously rolling single day, options. Every single day on SPX there is an Opex, right? And those 0 day to expiry options give participants a very, very powerful tool for being able to, not like short volatility measurements so much as short intraday realized volatility. So, every day we see what is it's being used for to form, if you've listened to me talk shit about the market, the saddle, right? There's always this big giant saddle that the market sits in, that the SPX sits in every day, and we just essentially roll around like the meatball and the cannoli, right? We roll around in this saddle, but we never really roll off it. So at this point, right, in order for vol shorts to go underwater, there's one of two ways for it to happen: either a huge gap down, right, or just a large enough intraday swing to send those intraday volatility shorts into a tailspin. And if that happens, then these vol shorts could be caught underwater intraday, and that's sort of like what happened in Volmageddon. But now with how much volume is being used in the zero DTEs, the effect can be magnified, and if participants can't step in and move the saddle fast enough or with enough leverage, the market makers will essentially be buying zero DTE puts at an increasing rate, and that'll push
An
volatility.
exponential rate.
Yeah, and so that'll push volatility up on all time frames, right? The spreads will blow out because the market makers will demand a lot more from the spread. So there's yes, usually vol going up leads into something, but that's usually informed participants beginning to hedge because they sense something, in the underground world, right? So like 2008, because of the instability in the MBS markets, participants were starting to see this in hedge vol. uh, we talk about 2020, same thing. The global pandemic was quickly brewing, and people were hedging their vol super hard. Uh, so there's always grumblings and stuff, but by and large, they don't look very different from other periods in time where you see volatility just go up and then go back down. So you can't really discern from this behavior that there is going to be a large volatility event. However, mechanically, there are ways for short vol to get blown out, right? And it doesn't really matter the time frame they're on. If those spreads blow out, closing out their short vol positions, the market maker is basically saying you have no choice but to take a huge loss when you close this short vol position to reduce your risk.
I mean, let's assume that there's probably a lot of spread selling. I think there was a lot of spread selling on the short vol side, especially going into July of last year. And those spreads acted as, kind of support a lot for as the market declined, right? The way spreads behave, when they go in the money is kind of interesting in that regard, especially on a cash settled instrument, and the way that that long put hedge affects the dealer positioning.
Well, basically creates a stair step in the hedge.
Yeah,
So if you assume a lot of those, a lot of the saddle is spreads, then you take what is an exponential growth in, a negative or a positive hedge and turn it linear.
yeah,
So, it is more of a tame downside, but once again, these market makers are so huge compared to the participants that you need to take a lot of leverage in order to reverse things if they get bad enough. Like we had that one day, I was talking to Jay Fresh about this earlier. We had that one day, I think it was last year, where we had like a big intraday drop and, the news went out and spewed all kinds of weird shit about it, about how it was like really not that bad, but it was actually terrible, but it really was the market makers were okay and everything was fine and everyone was, no one knew what the fuck was going on. The reality is that the market makers just ended up in a position where they had to buy puts. They had to buy 0DT puts to hedge all the fucking shit all the goddamn gamma they have further out on the chain. And so, and that's, the lady who was saying that, gamma was actually fine. I don't think she was necessarily wrong, but the reason why she was right is that market makers were buying 0DT puts.
yeah. That was here, by the
So
way, for those of you that are curious, at the end of July. It also coincided with the BOJ policy shift announcement at that time.
that's a big, yeah. A big intraday move begot an even bigger intraday move.
Yeah.
That's the meatball falling off the cannoli.
Um, and then obviously over September largely, and then again in early October, short vol continued to pull back. We kept snapping back into those ranges where they had spread, right. This is where they had put those spreads, and as those spreads closed out, we lost a level, right, and that kind of caused that stair stepping down that he was talking about with the more linear hedge, right? Um, and then again here in October we saw that, and then they sold off, and then that's when policy decisions reversed and stuff, and we continue to see that on our downside moves where we kind of fall below the range where those spreads are, and then we kind of snap right back to them um, over time, and then in the last month or so we've just kept moving higher and higher, but we keep snapping back to the bottom of those spreads, where those long puts are, right, and as those long puts gain delta, that's when things can really change. um and if the market makers, like George said, actively hedging that volatility in the intraday, they're going to be going long short dated puts with lots of gamma. And that's when the effect of these 0DTs becomes more pronounced even than it does to the upside. We watch 0DTs pile in on upside moves almost every day, right? They pile in, like at the money and just out of the money, and then they'll start to roll those up, right? And they keep that gamma really high on the next strike up, and that keeps pumping price higher and higher and higher. But in reverse, that works way, way faster because not only are participants piling in to that like put gamma, the MM is also. Whereas on the
Yeah, you
upside,
have
the MM is always selling against the rising price. On the downside, the MM is selling into the falling price.
right. You have participants in general only want to really hedge their beta to the downside. That's why downside is so volatile, is because like people who manage portfolios, they're going to have to protect their clients' money with SPX puts because they have a certain amount of beta. Like, let's say my beta is zero point 0.7 on this portfolio. Now I got to go buy basically, if I want to hedge 100% of the downside, then I'm buying like 0.7 delta.
Yep.
Or something like that. So that's
Yeah,
that's what they're fighting against.
kind of. It's very, very simplistic, but you're not wrong.
It's grossly oversimplified, but
Yeah.
they're hedging portions of their beta, and as the market goes further and further down, the incentive to hedge more of that beta goes up.
Croissant Man said 0 DTE can only be hedged with 0 DTE. So if someone sweeps the book, what will the MM hedge with?
Zero
Yeah.
DTE.
Well, yeah, I don't know that really makes sense. I think the way to say that would be
Gamma can only be hedged with.
most of the 0 DTE options are attempted to be hedged with other 0 DTE options, but you can't unless from a market maker perspective, unless there is a perfect alignment between buyers and sellers on either side of every 0 DTE contract, they can try to trade. They're going to have a 0 DTE position that they will have to hedge, and they can try to hedge it with other 0 DTE options, but at that point they have to go to other market makers to hedge those. And if every market maker has a position, then then you have to ask yourself, can they all perfectly hedge between each other, whatever the remainder is? And maybe some of it, but it can't be all of it. So I would say most of it, people try to hedge with other 0 DTEs, but there is some extent to which it just can't all be perfectly hedged at all times.
Yeah.
Yep. And that's also a good basis for the saddle as well,
Yeah, you
right?
have some other derivatives there that become problems like Vana. And then, color into close, right? Where it would become exceptional, and you see a lot of hedging occur on the 1 DTE as we approach close, because it's actually harder to, like, they just need to hedge off a range, but they don't bother trying to hedge with the 0 DTE at that point because there's no point, right? It's going to expire in like a few minutes, and so you'll see them get delta on the following day and try to hedge off like their total exposure in the range that we're trading in the prior day as gamma expands, because trying to hedge, and sometimes that doesn't work, right? And sometimes the gamma wins out and we get those crazy like 3 4 5 sigma moves like in the last two candles. But generally speaking, they're trying to they're going to try to net that hedge over the next time period. And I think that's true even earlier in the day to some extent.
Yeah. The zero DTE hedging dynamics, I can't imagine what the market makers are going through with hedging zero DTEs, especially when they're hedging other stuff with zero DTEs. Like, it kind of just melts your brain a little bit to think about having to do that, right? When someone buys like an at the money call with 0 days to expiry, how do you hedge the gamma on that, you know?
I mean, you try to get as much of it to close before the end of the day as possible, right?
Sure, yeah, but I mean, that trying to get it to close doesn't fix the problem where you have unhedged gamma. So it's just super interesting. I mean, I won't purport to understand completely how that goes, but I think Girk is pretty much on the money with how that gets hedged off into end of day, because your gamma exposure is so unpredictable, right? Because color is so high.
Yeah.
Like, color just goes insane.
Bull and bear traps. I mean, yeah, kind of. Like, I mean, you guys have seen it so many times, right? We'll have like a big strike here, and we'll have like a big strike here. It doesn't really matter what the price is. You know, we approach end of day like trading here, and then almost invariably, the MM will push up into the high strike, or they'll push down. I mean, it doesn't matter which direction they go first, but they'll push into like one of those strikes. They'll start hedging off into the following day, right? They'll start hedging, like they'll start building this position in the following day, right? And they'll, as they build that, they'll push into the low strike, and then all these options, which are at like 5 cents, will go up to like $3, and everyone will sell them off, and the market immediately spikes up to the high strike, right? Where those go up to like $3, and then everyone immediately sells off, and then the market maker lands right where they want to be. And that can go either way, and obviously that's why playing those like end of days is kind of a coin flip, because you don't know which direction the market maker is going to choose to hedge off first. But ultimately that's their goal, right? Is they want all that expanding gamma to contract back to 1 point into the following day where they're hedged. I shouldn't even draw it like that. I should just draw it like this, because this is what happens.
We should just overlay a lecture hall instead of a chart behind you and a whiteboard that you're writing on.
Probably. Is it hard to see the things because I have?
No, it's
busy.
fine. It's easy to do them. It's just but you're basically giving a lecture on gamma hedging extremely high color contracts.
Yeah.
So, but it's super interesting though.
Should we spend a little bit of time talking about just how awesome my prediction for this week was, or can we skip that?
I am not going to acknowledge your victory, because you clearly called Larry Fink before our Sunday stream and got the full insider scoop on where the market was going to go.
We did go up on hot CPI and then down on hot PPI, which is pretty much all I predicted. But we didn't fall as much as I would have liked to have seen. But I think we could have. I think the opportunity to fall to like 50-80 was always kind of open on Friday. It just didn't happen. 5100 held up really, really well, and it may continue to hold up. There's still a lot of positioning there as we move into this week. But if we lose it, we can lose it very, very quick. Gap down on futures. Yeah, that's what I'm hoping for. Is we just gap, like we take the bear move and we gap over the resistance. Bears haven't done that in so long, though. I don't know if I don't want to believe in them.
It has nothing to do with bears. It's bulls taking profits.
That's true.
Bears don't exist. I mean, there's no bears left. No, who's bearish?
Pickle jar.
I have some number of puts. This was it. This is the ultimate test of faith in the cult. How long can you be bearish?
It's like the salty spittoon in SpongeBob. Welcome to the pickle jar. How bearish are you?
Only the true believers.
Nuns with guns, yes, they take profits and then re-lever into more bullish positions.
Yeah, otherwise we just go flat.
Well, when options expire, you have no choice but to take profits.
Yeah.
There's a point in which settled cash is in their account, right? And this is a huge point right about tomorrow. This is a major point where they're going to have a bunch of settled cash, and it's not going to be in a position that's being hedged by market makers, at least for a little bit.
I'm sorry, what? Did I hear a third order Greek being discussed? Briefly.
The closer you get to expiry, the more they matter.
Yeah. Well, specifically the time-sensitive ones, right?
Yeah, exactly. Anything that has to do with delta decay is major.
We could talk about the effective speed on the market makers buying into shitloads of 0 DTE puts and make everyone really horny, but I think that's for another day.
Yeah, I don't want to get into I don't want to get into speed. Speed is a little more because like with time exposure stuff into expiry, that makes a lot of sense like intuitively, but speed, now we're talking, really fast moves on the index over points of really high concentration of gamma, and that's just a little more weird.
Opex week equals speed week?
Sure, I'm down. Although there's not, no, never mind. I'm not down anymore. I
Speed,
don't like it.
Lambda. I'm not an Ultima enjoyer, but some people are. Well, it's probably because it's useless. Uh,
Ultima's weird.
yeah.
Some of these derivatives are like,
They have so few cases where they mean anything or matter.
exactly, yeah, like Ultima in a market crash, maybe, you know, like that.
Ugh.
Like if the market was gapping around like crazy, then Voma might or Ultima might matter, but no, it's just so weird.
No more third derivative Greeks.
All right. We'll stop.
I want to get to the fourth order. That's what I want to do.
Don't you dare.
What?
I'm gonna
Like
make up Greek.
D delta D Voma or something?
D delta D speed.
Ooh. Gross.
or D color D time.
I hate you all.
That only matters milliseconds before close.
Yep.
God.
Hey, that fourth order derivative arbitrage will net you like 1,000th of a penny
Every year.
every
Bullish.
year.
Only if you can position yourself to be like long Veda.
Right? For a quarter of exposure, it only takes $200 million of leverage. It's all good.
Yeah, but
Just gotta let it.
you can make 0.001% on that $200 million every day.
Oh yeah, dude. Whew. Hedge fund activated. So Girk, I've been wrestling with my anger towards you for your prediction this week,
Yeah.
and my seething hatred for you know what you're gonna do. However, I think I've made a prediction that may make you a little more angry.
Oh, you son of a bitch.
You're gonna hate it so much
I
that
am. I can tell.
it's gonna be great. Anger of like a supernova star, white hot burning,
If it's
pure
any
hatred.
consolation, last week on Monday, the Bulls couldn't get it up until Tuesday. So I was wrong all day Monday. And then I was wrong a little bit about how high Bulls could push it. I definitely thought they would get the higher high. And they fucked that up really hard on Wednesday.
I wish I knew how SPX volume is calculated on TradingView.
Oh, I think it's based off the CFD.
Is it?
Yeah.
Uh,
Yeah, it's garbage. Otherwise, this would be really significant, right?
yeah, right. And it's like,
Sometimes I'll just look at SPY.
This like end of
You're
day
a cynical
candle with
futurist.
like more volume than's traded on it any day since December Opex. Except
yeah.
this one's red and not green.
Uh,
All right, let's do some predictions for this week. What do you guys think of that?
I'm down. Yeah, I got to start moving stuff. So let's get to it.
Come on, Jay Fresh. This is the big one. You don't now. I want both of you to know that not only did I say Black Monday first, I called it before both of you. So it's
Would you like to go first then?
no. Wait, are you guys
I
both
can go.
just gonna also predict Black Monday? Because I'm just gonna end the stream now if that's the case.
No, I have a better one.
Oh, okay.
But you need to hear me out before you end the stream, okay?
All right.
So Open flat.
Yep.
Close Monday 4,800.
Excuse me?
Okay, but now hear me out. Okay, hear me out. Hear me out. So we close Monday at 4,800. We could just call it whatever, 4,850. I don't care. And then we. Okay, I'll let you draw that line before I tell you my next step, because this is the part that's going to make you mad.
All right.
That's fine. Okay, now so next we're going to gap up to 5,100. We're just going to open at 5,100.
Overnight. Okay.
Overnight, yeah, overnight gap to 5,100. And then we're going to close the week at 5,200.
That's disgusting. All right.
You know what? And so here's my reasoning for this, okay?
I'm all
OPEX
yours.
sucks. OPEX sucks. Nobody wants any part of it, right? So the market goes down a bunch, okay? And then all of a sudden, some miraculous futures buyers show up overnight because Bostic says something like rate cuts.
They're on a blackout period.
Okay, well, maybe not Bostic, but someone says rate cuts. It doesn't matter who.
The Fed,
literally
the FOMC?
Somebody, it doesn't matter who it is, somebody's going to go on the news and say something about rate cuts. The market's going to go straight up. It literally doesn't matter who it is. They're just going to march someone out to say it.
Yeah.
So they're going to go up overnight because they said it. And then it's going to be neutral positioning into FOMC, where the dot plot is exactly in line with Fed funds futures. Statistically, that's how it shakes out. And then we just march our way up to 5,200.
Son of a bitch. All right,
You see, there was reason behind it.
What do you got?
So my kids are getting haircuts later. I don't know which way they're crying right now. Flat all week.
Okay. God, I fucking hate you guys.
I'm just trying to break the Monte Carlo, all right?
I see. All right, I'm going to go with, we opened down 50.80. Bounce back intraday, like 51.10. Sell off a little bit into close, back to 5,100. Then Wednesday,
This doesn't look like Black Monday.
I know. 51.10. Stable into FOMC, which is like right there. Then sell back off to 51.80. There.
Okay, that's a little more like it.
This might even open lower. This could open as low as, well, I'll just stick with, you know, I'll stick with 75. There we go. I don't know which one to hate more.
I think I'm going to win this week. Nice.
You think you're going to win?
I mean, statistically, I'm the most likely to win.
Well, that's because you just chosen spot.
Yeah.
Yeah. I know why you choose flat week over week. I'm not stupid.
He's trying to
I still somehow lose all the time.
Yeah, that's true.
So what I did, so yeah, my prediction, it serves a dual purpose, right? One, it's not, and it's entirely out of the realm of reality, but it's fun. And two, it returns back to a mean, so I'm pretty safe into end of week.
I think if we don't, okay, at some point in here we should probably note that there is a small possibility that tomorrow's market open is under gamma neutral. And if that occurs, we may be at delta neutral very, very quickly.
If I'm right about Monday, I'm probably going to be wrong about the rest of the week.
Yeah,
I'm not going to lie.
Yeah, you're probably very, very, very wrong about the rest of the week.
Yeah.
But yeah, so keep that in mind. Although the positioning at 5,000 should prevent it from getting too crazy. If by some off chance we happen to fail 5,000 at any point, it's all over.
Yeah. The Bulls are going to be picking up the pieces.
So just keep that in the back of your mind. But I mean, these are mostly just for fun anyway.
Yeah, as you can tell by my chart,
would it be possible to gap up 4,800 to 5,100? It's 4,850 to 5,100, and no, Dork's being an asshole, but we could gap a lot of it and then run the rest potentially. I would say if that happened, we'd probably end up neutral into FOMC around like 51.15 to 50.50, like this range right here. Positionally, that's where it's going to find like the most support. So I could see a gap below 5,000 returning to 5,000, but not. And honestly, if Dork's right and this were to happen tomorrow and we were just to drop, fucking 350% or 350 bips, we're probably not going to stop going down, maybe ever. Like many people would just instantly blow up. It's not even funny. So I mean, not only do I think that's unlikely, if it did happen, the reversion of it would not.
Yeah, we'd be going below delta neutral, and yeah, it would be so ugly.
Yeah, we would just be rocketing down at that point. I mean, there'd probably be some like crazy bounce intraday, like towards the end of the week, on capitulation, but even that would probably just take us like back to DN. Yeah. MM wouldn't be long Vana. That's that's a whole nother story.
I mean, they would be on Monday, but the rest of the days, that's been a bigger question.
Yeah, on shorter time frames they would be, but like on the SPX monthly, that wouldn't happen unless we fell I don't remember, it's like under 4,200 or something like that.
Yeah, it would have to be that would be literally the market crash.
And that if that happens, let's keep the theoretical probabilities open here, and let's say we did fall under 4,200. That means the SPX is probably going to like 2,000. Yeah. Maybe lower. Maybe it just keeps going down until they like ban short selling or something.
Yeah, or the Fed cuts and pivots and does all that shit.
Yeah.
All right, you two are feeding each other in a never-ending loop. We gave our predictions. Let's end it.
All right, fine.
End the suffering.
Thank you guys for coming on. I appreciate it.
Thanks for having us.
Yeah, always fun.
Yeah.
See you at Futures Open for the market crash.
Yeah.
Yeah. Later, guys.
All right. See you.
Later, guys. All right, everybody. I'll be around for Pickles Picks for the rest of the day. I got a bunch of research to do and stuff. So if you have any questions and I didn't get to them on the stream, feel free to reach out to me and I'll try to answer them. Pickles Picks will be out tonight. Probably. I'm going to wait for futures and see how that looks. So maybe I'll wait through the China data before I start writing them up. So figure starting around like 9 or 10 o'clock. I'll start posting them, and then I will see you guys tomorrow morning. So everybody have a great night. Enjoy the rest of your weekend. Later.